Welcome back, everyone. My name is Lucas Miller, of course, host of the Fear-Free Passive Investing podcast and this YouTube channel. If you're new here, we help busy professionals navigate the world of passive commercial real estate investing. This is part 2 of a 2-part series where we talk about investor due diligence items before making your first or your 20th investment in a passive commercial real estate deal. If you missed part 1, it'll be down in the description if you want to take a look at it, or we'll have a link to it here in the video too. But let's get started and jump right back into where we left off. All right, so the next point we want to pay attention to is location. Location of the property specifically. Where is it in that geographic region, within the city or within the town, wherever the investment is? Does it make sense to be investing in a property there? Are you in the path of progress? One of the things I love to do is plot out where all the Starbucks are and where all the Chick-fil-A's are and Trader Joe's, things like that. So you can look at those and say, okay, is it anywhere near any of those? Or is it near like a bunch of check cashing places? Or is it near a bunch of liquor stores with bars over the windows? You can get a really good idea of the location of the property by just doing a Google drive-by street view. Okay, the next thing you want to pay attention to is the visibility of the property from major corridors or thoroughways or highways. You want something that has good visibility. Usually when a property is in a really good location, they'll put a traffic count. And it's an estimation of cars that drive by every single day. Sometimes it's like 30,000, sometimes it's 100,000, sometimes it's like 1 million cars a day. Obviously, the higher number, the better. You want to get your product in front of more eyes. And so having something that's nestled away in a neighborhood might not be the best idea, with the caveat that it might be great for families, right? If I have 2 little kids and I have to live in an apartment, I'm not gonna wanna live on a busy thoroughway with a ton of cars going by all the time. I might want to be nestled back in the neighborhood a little bit more. So does it make sense? Does the traffic count make sense for the asset? And then you can just ask the question, why is the sponsor excited about the location of this deal, right? There's usually something drawing every sponsor to this deal, like, oh, it's really close to the downtown corridor, or it's really close to this big job center, or it's really close to the beach, or it's only 10 miles from this huge tech hub. Whatever it is, there's usually some sort of benefit draw to these properties if they're in good locations, and you want to know that before you invest. Okay, for the next point to look into, we want to talk about returns, right? That's the whole reason to invest. But you'll notice that it wasn't at the very top because it's not the most important, right? I put preservation of capital first and then your return second, right? You want to at least be insulated from losing money, and the more things you can do to stop that, the better. So let's talk about returns. What are the returns that they are projecting, and how are they projecting those terms? Are they using terms like cash on cash return, average annual return, or IRR, which stands for internal rate of return? Or are they saying vague general terms like, oh, you'll get a 10% return on your money? And it's okay to say that, right? But you gotta be specific. What are you talking about? Because you want to know what returns they're talking about, right? Cash on cash return is much different than your internal rate of return, which is much different than your average annual return. So you really need to understand what they're talking about when they say you get an X amount of return on your money. And something you can ask them are, what are you not telling me, right? And this isn't, I don't mean this as like a gotcha question, like, no, I have things that I hold back from my return profile because I don't want to overpromise and underdeliver, right? I want the opposite. So it's okay to ask your sponsor, hey, what are you not telling me about this deal that you really like? What are you excited about that that's not in this pro forma? Likewise, you want to make sure that there's nothing bad that they're talking about either that they're hiding. And usually if they don't have something that they're holding back like I do, they might be projecting the best case scenario, in which case you don't want to invest in that deal because very rarely do things go perfectly according to plan. And in January of 2020, right now when this is being recorded, we are at a point in the market where things are running very well, right? Interest rates are very low, occupancy is high. Things like this don't always happen. So you ought to be concerned about what happens when things don't go according to plan. And finally, do they have a track record of achieving those returns that they're advertising on projects that are very similar, right? You want to know that they know what they're doing, they know what they're talking about, and they can get that done and across the table for you. And one final note, and I guess this is a sub point, right? But you want to make sure that they're not trying to confuse you with these really complicated return terms, right? Internal rate of return is very confusing, but cash on cash return, average annual return, those are really easy to understand things. You shouldn't be getting complicated answers from them. And if you are, ask them to clarify. And if things don't get clear, you really need to think twice about investing, because these aren't very complicated terms that nobody can understand. If you need a little bit of help, ask for the help. And if they don't deliver it in a way that you like, it might be a sign that they don't know what they're talking about, or they're not willing to work with you. Either way, you don't want to invest with them. Okay, let's talk about IRR a little bit, because it is one of those things that's a little confusing, but essentially, and don't quote this as scripture, but IRR is essentially the time value of your money invested in the deal, and because your returns come from different times, right? You might have a 8% cash on cash return in the first year, and either like a 15% cash on cash return in year 5, or you might not have a high cash on cash return, but you have a ton of appreciation that comes on the back end sale. No matter what, that IRR number needs to take into account your average annual return based on time. Basically, you think of it as the time value of your money while invested in that deal. That's an easy way to understand it. One question you can ask them to let them know that you are very serious and well educated is, do they know the breakdown of where their IRR returns are coming from? Because like I was saying, you can have cash flow returns and you can have appreciation returns. If your deal is strictly based on cash flow, your IRR is probably going to be a little lower. But if your returns, an easy way to juice your IRR returns is to have this crazy sale price at the end of the hold period that's juicing that return. So what you can ask them is, do you know the breakdown between cash flow and appreciation? Now, we're at what some would say the top of the cycle for multifamily right now, again, January 2020. So a lot of investors are looking for cash flow, right? Cash flow carries you through hard times. So you want to make sure you have a deal that is cash flowing well, or a very significant value add that you are making that assumption going into it that you could lose that money, but it's also returns are much higher. So asking them, do you know the breakdown of your cash flow versus your appreciation returns in that IRR profile? I like to shoot for somewhere around 50%, frankly. I like having a significant amount of cash flow in the deal so that if we don't hit our sale price in year 6 or 7 or whatever it is, we can just hold that property. So if valuations aren't where we want them to be when we're ready to sell, we just hang on to the property, right? It's cash flowing well. Or another strategy is to just refinance out of it. And if it's cash flowing, we continue to get that appreciation, that cash flow, that debt pay down, while you already have your capital back. Now that doesn't happen every time, but it's something that's like a little extra on top that you might not plan for, but might happen. So all of that to say, just make sure the deal is tailored to your risk tolerance. Neither one of those deals is bad, but you got to know what fits with what you want in your risk profile. Okay, so the next item that you want to pay attention to is the debt structure or the financing structure. Assuming they use leverage on this deal, which probably a vast majority of syndicated deals are using debt. So what does that debt look like? Is it an agency loan, which means like a Fannie or a Freddie loan, something that's usually a HUD approved loan, Housing and Urban Development? Those are usually the best case scenario for long-term low fixed rate debt in multifamily. But there's also bridge loans, which are just like it sounds, a bridge to that long-term financing where it might not qualify for agency debt right away, but you can use this product to buy it, rehab it, and then move into long-term debt. Is it recourse versus non-recourse? This really doesn't matter a lot for the investor, but it's something you should know. In case of default, if the loan is non-recourse, right, the lender's not going to go after the sponsors. Of course, they will never go after the investors. You should know that. But if it's recourse, they'll go after them. If it's non-recourse, they won't. Assuming that there's been no fraud or negligence or gross mismanagement of the fund, they will not go after you to sue, or they won't go after the sponsor. You should really know where you stand in what's called the capital stack. So there's usually just equity and debt in most cases, but if your sponsor is using complicated structures with mezzanine debt, and we're not going to get into all of that, but you should know where you sit in that capital stack so you obviously know where you're going to be paid. Worst case scenario, if something goes wrong, you want to know where you're at in line to get paid. And then one more really important thing is, are they going off of an actual term sheet or are they just going off an assumption? So if they're underwriting based on assumptions, things change constantly, right? You can look at your phone and see where you're at with interest rates and LIBOR and things like that that really affect your interest rate, locking it in. Plus, you have no idea whether you're in a Fannie pre-review market or and all these things. You don't have to understand what I'm talking about. Just know that if they're underwriting based on an assumption, that's way different than underwriting based on an actual term sheet, meaning the lender has said, yes, here's what we will do in that region, here's what you can expect for an interest rate, and here's where we're at with loan to value or loan to cost, whatever you're using. I have had deals change drastically than what I, quote, assumed they would be, whether it's years of interest only payments or what the amount of money that they would lend, things like that, that you make your best judgment, but then you get an actual term sheet and things could be different. So you want to make sure they're underwriting based on an actual term sheet. Next, let's talk cap rates. Now, for value add multifamily, going in cap rates is kind of, I don't want to say it's irrelevant, but it's not as important to me as if you were buying an office building or hospital or really anything that is, quote, value add. Now, your going in cap rate is important to know only because you want to know where you stand in a prevailing market. If you're buying something at a 4 cap in the market, prevailing market is a 6 cap, now that might be a problem. It might not be. Your sponsor might have a very clear plan to add that value quickly so that you exit at a higher than the 6 cap and you make a bunch of money, but you just have to know that the value is there. That's all. So you need to understand what their going in cap rate is and what their exit cap rate is. You don't really need to know cap rates in general of the areas. You just need to know that their reversion cap rate, usually their exit cap rate, needs to be higher than what their entry cap rate is. And what I mean by that is if I am underwriting the deal and the prevailing market cap rate is at a 6 cap, let's say, and my exit is at a 5.9 cap or a 5.8 cap or even a 6 cap, I don't want that deal. Because think of it this way, you're basically saying 6 years from now, I'm assuming that the market is where it is at today. You never want to make that assumption. You want to make the assumption that I'm buying today at this value. I'm confident I can raise the value, but I think that our market is going to go down, and I never want to count on appreciation, so I'm going to assume the market is worse when I go to sell than when I'm buying. So that does a couple things. One, that shows that you have maturity in this game, right? Like you understand that the market doesn't always go up. Two, it shows that you have the sensitivity analysis that a lot of investors want to see, meaning that you're accounting for some sort of correction or slowdown in the market, which is important. Everyone should be doing that right now. So most conventional wisdom from a lot of people being taught these days is 0.1% for every year held. Now what that means is if I buy at a 6 cap and I'm holding for 5 years, we will exit at a 6.5 cap. Now I don't like this rule for a lot of reasons. Mainly because I don't believe in rules of thumb, right? I believe in vague, okay, you can get close to that number, but when you're underwriting a property, when you're buying millions and millions of dollars worth of real estate, you don't want to be depending on rules of thumb. So you really want to do a deep analysis and a deep dive into this and really figure out what the value is of your property, what you think is going to happen, and make your best assumption based on those things. What I see happening lately is that people are buying deals at 4.5 caps or 5.5 caps, whatever it is, and then saying, okay, so I'm going to add 0.1% for every year held, 5.5 cap, 5-year hold, we're going to exit at a 6 cap. Well, that's fine if your prevailing market cap rate is a 5.5 cap. But what happens if the prevailing market cap rate or the prevailing values of your deals are actually at a 6 cap or a 6.5 cap and you just overpaid for your deal? So now that exit cap rate of 6 doesn't look so good. So what I like to do is I'll start with 0.1% for every year held, but instead of doing it at my cap rate at purchase, doing it what the prevailing cap rate is. So you got to pull well, you don't have to as an investor, you just need to know what to ask for. But the sponsor should be pulling that information from various sources to figure out what the prevailing cap rate is and how they can do a conservative cap rate reversion. Also, one more note on cap rates. Another reason why I don't like cap rates is because my calculation of a cap rate is going to be totally different than somebody else's, right? Essentially, a cap rate is a valuation play. You take your net operating income and you run you take your net operating income and you run a valuation calculation based off of that. Now, the problem with that is, are they using the trailing 12 data to pull that NOI? Are they doing the trailing 3? Are they doing current net operating income? Are they doing a pro forma net operating income? So there's a lot of different weird nuances that you can do to skew your data one way or another. Deals like this are really hard to underwrite, but you just got to pick something and be confident in that. So you can see how hard it would be to calculate just a general cap rate number because there's so many different ways to calculate it, right? So your sponsor really needs to understand what they're calculating, what data they're using, and how they can use that data moving forward to be conservative. On being conservative, let's continue on and talk about break-even rent and break-even occupancy. These are numbers that basically are exactly what they sound at. What can we break even at if occupancy drops to X%? Usually the deals that I do are somewhere around 60% occupancy. And the deals we're buying are at 90+% occupancy, so that's a long way to fall before you hit that. And then break-even rents will be specific to every property, right? But in general, it should be pretty drastically lower than what you're achieving now. Okay, so let's talk a little bit more about the submarket. So I know we touched on location earlier, but there's some more information within the submarket that you want to drill down and do some additional more due diligence on that. Specifically, what is the development activity in the area? Development activity points to a lot of things. If you're buying a multifamily property and they're developing a lot of multifamily property, that might not be somewhere you want to be. If you're investing in that same multifamily, but they're developing a ton of new shopping centers and malls and food locations and new houses, it might be somewhere you want to be. Also, if your sponsor is talking about growth in the area, you want to figure out what that growth is from. You want to figure out if the dollars that are flowing into that area are development dollars or are they government dollars. Now there's a difference, right? People think like, oh, they're pouring a bunch of money into that area. Okay, who's doing that? Is it developers? Is it the government? Usually, unfortunately, the government likes to pick their winners and losers. And so they might be taking tax dollars and pouring them into an area and pouring them into an area, trying to make it better, but then it's still a place that nobody wants to go. So all that money is wasted. So if you make your investment decisions based on where the government is spending all their money, you might get burned. Okay, next item. Now this one might be a little tedious, but it is important and it might show you a lot of inefficiencies here. You want to take a look at the trailing 12 data. Usually this is just an income and expense sheet from the property because a property is run like a business. They should have this. You want to look at the T3, the T12, which is the trailing 12 months and trailing 3 months. And that happens on a running basis. So you want to look at that data and figure out if there's any large jumps or large deltas in their pro forma underwriting. Now what this means is if rents are historically like very low and there is a big jump into gross potential rent, you want to figure out what that is. Similarly, if there's a big drop in expenses, like say something like, oh, I don't know, trash. Like, okay, you're paying $1,000 a month for trash service. And then all of a sudden on their pro forma, it drops to like $400. You want to figure out what that is because those little mistakes like that can really add up and you're like, okay, so now your expense went from 40% to 80%. Something crazy like that is very well possible if you're not underwriting using conservative assumptions. A really good rule of thumb with these service contractors like trash, maintenance, sometimes third-party contractors, is you never want to assume you can get it for a lower price. And that's the same thing with insurance too. We're going to talk about that in a minute too. But you never, ever, ever assume you can pay less for the same product. Now, that might not be so true if you're trying to increase efficiencies. If they're just running a property really heavy, you might find some efficiencies there, but you gotta have comps and you gotta have quotes from multiple property management companies that support that. So on that same note, let's talk about taxes and insurance. Taxes and insurance are one of those things that people just assume it's gonna be the same under new ownership. That is not the case in a lot of cases. So you really wanna know, are they using a professional's opinion to use that number when underwriting? So there are tax professionals and there are insurance professionals. Both will provide you hard quotes before closing, and they should be using those numbers, not going off of a rule of thumb, not going off of even another property that they have. If they have a property that's close by, it might be in another county, it might be in a different area, and taxes could be totally different. Insurance could be totally different, whether it's in a floodplain or not. They need to be using actual hard numbers from quotes. Okay, so the last three items that we're going to talk about are, in my mind, some of the most important, and it goes back to why these deals fail. Specifically in multifamily, but also in other commercial real estate, why these deals fail are usually management related, or they're undercapitalized, or the team has some sort of problem. So let's talk about team for a minute. The sponsor team should have a well-oiled machine almost. Like they've done this a few times before. They know how to work with each other. This isn't their first time. That alone will save you a lot of money if you just follow that one piece of advice. Don't invest with someone brand new. And along that same line, you got to figure out who is doing what on the team, right? You'll see a couple pictures of people, maybe a couple different companies, and you say like, okay, who's the lead here? Like, is this, Joe Schmo being the lead, and this other person like Jane Schmo, is she just like a supportive role? Or is it really her deal? So you got to figure out who's involved and what each person is doing. And then you want to talk about the management role, right? The actual on-site management, or the management company who is going to be doing the actual management. And who they choose to do that is very important, right? You got to know what their track record is, as well as the sponsor's track record, right? You're handing over the keys to a multi-million-dollar business and expecting them to run it the way you would. It's just not going to happen. So you got to have a really good idea of how their business operates and what their protocol is if their management company isn't doing what they think they should be. Another reason these deals fail is they're not well capitalized. And what I mean by that is they don't have enough money. I just bought a property out of foreclosure last December, and the story behind it was that the owners got behind, right? They weren't making as much money as they thought. Either their rents projections were too high, or they just weren't collecting the right amount of rent. Anyway, they stopped putting money into the building, meaning they stopped making basic repairs, right? The siding was falling off, the parking lot was in shambles, and so what happens when you do that is tenants stop thinking that they're getting the value they're paying for, so they stop paying. The worst thing that happens is the good tenants leave because they're smart, right? Bad tenants stay. And that's the biggest problem, is then you start getting really bad tenants in there, and things just start spiraling out of control, and it gets really bad quick. Not only do you want to be conservative in your underwriting and making sure that you're going to hit the right number of rent that you're going to be collecting or revenue that you're generating, you also want to make sure that you are well capitalized to deal with any sort of unforeseen circumstance, which there always is one. And so the way that I personally do this, and I don't know, other people might do it differently, but I keep a buffer fund, right? Just a certain percentage of revenue aside for emergencies. And I have a working capital fund. Usually that adds up somewhere around 10%, right? And you want to keep that money on hand at all times. Sometimes you use that to complete repairs and then get a draw from the lender where they reimburse you if it's structured that way. But whatever that is, just know that you should have a buffer fund, a pool of money set aside that no one's really spending on stuff and not replenishing, because that's really critical to making sure the property is healthy at all times. All right, everyone, that's the end of part 2 of this 2-part series. Again, if you haven't watched part 1, go back and take a look at that. Make sure you are also subscribed and have notifications turned on because we will have tons more content just like this popping out every single week. If you think I missed something or you had a question about anything or you want to argue with me about something, go ahead and put it down in the comments and we'll talk about it there. And if you haven't checked out Fear Free Passive Investing Podcast, it's awesome. You should do it too. It's different content than what we talk about here. So there will be a link for that down in the description as well. All right, and that's all I got for you. We'll talk to you next week where we bring out more content that's going to help you be a better passive commercial real estate investor. Thank you. I appreciate it.